When we left, he said, well, guys, and don't forget, to become a good VC, you have to lose 50 million. Otherwise, you're not going to become a VC.
Looking from today's perspective, like something worked. What do you think was it at the early beginning that set you apart?
In the US, we were co-investing with good names, the Sequoias, the Mayfields, the Kleiner Perkins, and so on. But we didn't realize that we're happy to find some dump money from Germany, basically, to put in the bad deals and didn't let us into the good deals. There's exactly this one fund raise missing in the history of Earlybird. But it was impossible to raise back then. We supported our investments, the good ones we had back then, with investing our own money in the end, our management fees. So we didn't get any salary for years. So there was a pure entrepreneurship in the end. Our first fund was among the best funds in Europe back then, and delivered the 4.5x. The most craziest time I've seen in basically in the whole history of Earlybird was back then. But I would say we're almost there again. With regard to AI companies, it's already, the craziness is back.
Ladies and gentlemen, by way of introduction.
Christian, what is your personal mission you are on? What is your goal and what is your personal big dream?
If I start with Earlybird, it's clear. I mean, we produce good returns for our investors. That's the ultimate goal in the end. By doing disruptive things, basically by investing into disrupting technologies and founders who want to change the world and basically build something which disrupts old things. That actually has been our mission since the start. So since the early days, obviously with the very different technologies, very different setups, very different concepts, and so on. So what had always been the idea of doing exactly that, and with this creating value in the end. So that's something what's behind, because obviously we are here to invest other people's money and deliver good returns, and by doing so, we think we can do this. We can do this better maybe than with other concepts. So that's has been driving us, or me personally here.
And how does this align with your personal goals? Because what I always think is that there are certain personal goals, and then you find a tool to execute on it, which in your case is venture capital and proved to be quite successful. So how does the goal with Earlybird that you just described align with your personal ambitions?
Well, personal ambitions have always been also basically to change something, to change things to the better, to be on the forefront of innovation, to learn about innovation. So that's something which always intrigued me. And obviously you can do this in different dimensions. I have been doing this in sailing, I've become very successful in sailing. So you can do this in some dimensions, I'm so passionate skier, really bring it to the edge and use data to make changes and so on. So that's something what combines a little bit also the thing. And also VC is something which you basically have to do, I would say 24 hours, 24/7, something like this. So, as you always have phases where things are happening and where you have to be available, where you have to be accessible. So it's hard to do it kind of a 9-to-5 thing. It's always around, and you always have to take care of founders, of issues, and especially your portfolio. There's always something going on. Some companies are developing well, and then suddenly something happens, and you have to be there. And there can be different companies developing well for a certain period of time, and then suddenly something changes.
Yeah. I like that it seems to be rather an approach to life than anything else. If you're also like kind of questioning or trying to disrupt other industries in your like skiing and sailing that you mentioned. And if we go back to the very start of Earlybird, how did it begin? Like, how did you start Earlybird? And for this, could you give some context about the state of technology, venture capital, and entrepreneurship at that time?
Yeah, no, happy to dig into this. The story is I basically, after having finished studies, I was with McKinsey a couple of years, did the first project for McKinsey in Eastern Germany. It got me so excited, basically, that I have to leave McKinsey and do something on my own to become an entrepreneur. And this is what we did with colleagues. Basically, we bought companies from the state holding. There was this state holding called Treuhandanstalt. It was called back then, basically, which owned the assets of East Germany, because it was a socialistic and a communistic state, and so it was all owned by the state. And then they built this kind of super holding from which they sold all the assets. And this is what we did back then. And what we applied there is a principle which has been working very well. And those companies were kind of pre-rundown, difficult cases. Most of them were machine building, machine construction companies. So oily, greasy, and kind of stuff which is special, I would say. nothing to do with venture. So that's that respect special. And what we did is basically we took those sometimes pretty big companies with a couple of thousand employees, which have already been reduced, where we took them over. But anyways, the structure were there, the machines were there, the space was there, everything was there. And what we did is basically we separated, we built many small units along the value chain. So basically, we started with drill machines. We say with drill machines, we build a company out of drill machines. And the next step was basically the assembly. We build a company which does the assembly. Then we had the next company which does all the testing and the measurement. We built a company around this testing measurement. Then we had a company which did basically the installations on the site. And we also built a company around the installation part of it. So across the value chain, basically, just a couple of examples, we built companies. We had identified very early then the people who could run this. We said we incentivized them, gave them some shares, incentivized and say, well, you pick from what is there, what you need to run this small company. And they picked the machines they need, they picked the people they need, and they picked the space they need. And then they got off. And with this, and we in the holding kind of where the whole structure, which basically was implemented in the first few weeks, really, we did this basically. We put all the people also in basically in those companies, which were defined and by the leaders of those companies, at the end, the managing directors of the companies. And this worked quite well. We in the holding basically kept all the rest, which nobody wanted to take. And that included indeed also employees, it included space, machines and everything. So we took care of all that. And these small units, we told them, go out, not just live from within, not just basically make offers to your colleague companies here. Go outside and basically offer your service to other companies, meaning drill services, meaning measuring services, meaning installation services, and so on. And that worked quite well. So these small units became profitable pretty quickly. So after a few months, some after half a year, they already were profitable because they only had what they needed to run the business, not more. We took care of the rest. So, and with this worked quite well, and this worked so well that the state holding said, "Okay, we have another difficult case. Can you also take over that one?" And this went on. That went on, at least for me, it went on 3 times, and then they said, "Okay, we don't do these deals anymore. We stopped doing this." And there was also the time where the internet came, where the neue Markt came, basically. So companies could go public. The first time in Germany ever, basically, that companies without financial numbers, with just concept could go public, which was crazy back then. And we said, well, this is much more interesting to invest into something which is more towards the future in terms of really more to disrupt something. It was obviously the internet. And then in Germany, it very quickly picked up. In 2000, we started in 97. We had a first fund in 98. In 2000, I think there were more than 100 venture funds in Germany, so very quickly picked up. Many of them, I would say, there were corporate venture funds. So because all corporates felt back then they had to do something, and so it picked up quite quickly. And as quickly as it picked up, it also went down because in the beginning of 2000, in March or April 2000, it was the bubble burst and the stock market started to crash. And that was obviously the end of the party. There was the internet crash then, which happened not just in Germany, it happened everywhere, also in the US, with the big difference that back then in the US, they were used to these cycles in terms of they had been living through this. All the industry, all the venture companies and so on, they have lived through this. Whereas in Europe, especially in Germany, nobody had experienced that before. And people may remember the telecom stock, basically, which was celebrated back then as the hottest thing on earth, which fell dramatically down, and everybody was affected by that because everybody who was active in the stock market basically had the telecom share in the portfolio and was obviously not very happy with that. And so the recovery took much longer than in the US. In the US, it started recovering very early. So for us, it was kind of, we called it back then nuclear winter. So it took 4 years basically where nothing happened. And we were lucky in that respect that we could live from our second fund generation, which we raised back then, which we could live off. Which was raised in the beginning of 2000, so really before the bubble burst. So we had the last basically investors coming in the calls up until mid of 2000. So and that basically helped us surviving this phase and then making still investments and and so on. But then it took really 4 years where it was hard to exit anything, where it was hard, where fundraising was impossible. We also basically missed one fund generation. The next fund we could only raise is back on first exits we had in 2005, 2006. Only 2007 we were able to raise the next fund. Basically on the back of the successes of the first fund, we were able to raise the next fund. So there's exactly this one fund generation missing in the history of Earlybird, which could have been a 2003, 2004 generation, but it was impossible to raise back then. It's also the outcome of the Neue Markt was also remarkable. I think 330 something companies went public. I'm not sure if you would recall one name of them. You wouldn't, at least. For me, it's hard to identify any name of those companies of the companies. Whereas in the US, those times the Amazon were created, the Googles were created, so companies which are global, leading companies, most valuable companies globally. Nothing of that happened back then in Germany.
And on this very last point, what was the hypothesis that you started out with? I'm asking this question because a couple of weeks ago I spoke to Andre Bartosz from Credo Ventures, and he said when they raised their first fund in the early 2000s that they told the LPs that this is an experiment and that they might not even see their money again. So what was your hypothesis that you started out with, and how did you operate on it?
Yeah, well, our hypothesis was that you can earn a lot of money with this. Because back then the times were crazy, because obviously everybody was thinking and seeing on the Neue Markt how it can work, how you can become a millionaire, billionaire, whatever in just a few months. So that was kind of, it was crazy. The most craziest time I've seen in basically in the whole history of Earlybird was back then. Also with regard to fundraising. So it was a meeting, and we got a commitment of 50 million for a fund. So which was quite a lot back then. So now it takes years, to build the relationship and basically nurture this, get to know each other and so on. So all that in that respect was kind of crazy. That's why we also thought, okay, well, it's an easy thing, we will easily do 4 or 5 times the fund, and which we actually delivered back then. So we our first fund was among the best funds in Europe back then, and delivered the 4.5x. So that's really something what happened. But so we were we were very optimistic back then, and basically in late 2000 was still okay, but late 2000 really everybody realized, okay, well, this is really going sideways. And it's not. It will take some time also.
Yeah. And looking from today's perspective, like something obviously worked, like how you started out. So what do you think was it at the early beginning that set you apart also from the other venture funds and that kept you going?
What I did previous before starting Earlybird, it was always that we had the idea of separating risks. So the concept I mentioned at the beginning in terms of separating all and building some small units, typically it was something between around 10 plus minus units we basically created very early on. The idea was not so basically to have small units basically develop faster than, but it also was a risk separation. That was also the idea basically, because with this we could separate these risks. And if one of these smaller companies would have not worked, then it would not have harmed the entire, you can call it fund almost. And that's something we then applied. So it was not new to us in the end that we would have to apply this in a fund, obviously. So you have to do proper portfolio management. But also sure, we did everything wrong back then. So we overinvested, we overcommitted. So all these things we did wrong back then. But at least we kept this kind of principle that we need to have a portfolio. We also should basically invest in different sectors, not just allocate the money in just one sector. So that was important. So that, I think, led us to also the success then of the first fund. And the second fund generation, so we committed all mistakes with regard to US expansion. So we learned our lessons there. We had a different team there, and hired too fast without basically building relationships. We had a different strategy in the US. We were co-investing with good names. So the Sequoias, the Mayfields, the Kleiner Perkins, and so on. So we did co-investments with them, but we didn't realize that they were happy to find some dump money from Germany, basically to put into the bad deals, and didn't let us into the good deals. So that was something we didn't realize back then. Well, we realized then, but it was too late already. So there was a lesson learned in the US. We closed down the US, said, okay, well, we have to focus, we have to follow our strategy. And the strategy was always, given our operational experience, that we have to be in the lead. We have to be close to the entrepreneurs. We have to help the entrepreneurs. We need to form kind of partnership things so that we really support the entrepreneurs on their way and share the experience we've made. So there was this you can only do if you're a lead investor. If you're not, basically, you can't do this. In the US, that was a mistake. We weren't that. And first time we thought, okay, well, we would be better than the average in terms of, well, we can do better than just 10% real winners in a fund. No, we weren't. We have these 10%, and this is we couldn't beat that so far. But at least we have that, and in every fund and every function we had them, and also the principle that you should not over allocate it. You need a certain balance in the end, and you also something we refined now only in later funds. That since in the beginning you don't know which companies would be the winners, you have to basically first of all have to have the same bar in terms of entry bar for everyone. So they have the same, every company we invest into could have had the same potential because you don't know which one is going to be. And you should also apply the first some principles in terms of applying the same terms, meaning also ownership terms in terms of exit terms and so on. So that should all be on the same level, and you should not basically compromise on that because in the end you don't know which one will it be. And if you end up then in a very successful company where you just own 1%, it's not meaningful enough to pay back fund or create some returns. This principle is also very important. So kind of also a disciplined portfolio investment and not just invest on the go.
I think once I heard you say that the education of a VC costs 50 million, right?
Yes, that actually we learned when we started. We actually did a tour then to Silicon Valley and it really met the top funds who were also around now, the Sequoia and Kleiner and so on, and among others NEA, and they were all Central Road was pretty easy. Basically, you couldn't just drive from one block to the other and could meet all them. They were very friendly and happy to meet us, and I got these old sayings then, okay, well, we're never going to invest in Europe. It's too far away. We are so happy to invest basically in driving distance. And so all these kind of talks we have then basically realized life, so to say. And there was also, then when we left, indeed, and it was Dick Kremlich, basically the founder of NEA, who died recently, by the way, but he was already pretty aged back then. When we met him, he was already in the late 60s when we met him. And he said, I'm on a deal diet, so kind of with mid 60s. And then he said, when we left, he said, well, guys, and don't forget, to become a good VC, you have to lose 50 million. Otherwise, you're not going to become a VC. And we said, crazy. How can we lose 50 million? Our first fund was 50 million, 50. You know, how can we basically lose 50 million? Each partner, he was not saying the company, each partner. Now, with hindsight, looking back, we reached that, you know, in terms of money we lost with investments made who basically did not pay back, or we had to write off or write down or whatever. And we are there. So we reached that.
You covered your 50 million, so.
Yeah. And not just me, my colleagues as well. So it's kind of it's whole. You learn really by doing this. That's why portfolio is important. That's why partnership is important. Also to have them some checks and balances around. So that makes the model successful in the end. You know.
And what was the first investment where you thought that this whole thing could actually work out? I mean, like I can give you an example. Like for me, it was not so long ago when I started with the podcast, and because I literally did not know what venture capital was at the time, and I reached out to a bunch of people, like among others, Saul Klein, and invited him to my non-existent podcast at this time. And he replied, and he was happy to join me. So this was for me kind of the moment where I thought, okay, this might be actually working. And yeah, I'm curious, what was this for you, this moment?
Well, the interesting thing, we had companies where we thought they would be working that did not work out then anyways, because of different reasons. We've seen everything. We have seen founders split up. We have seen founders disappearing. We have seen kind of things. So most of the things which did not work out, and that's why also basically we changed most, or the most over the course of the time is basically how can we make sure that we get a better feeling, a better judgment on the people we are investing into. I think that was back then, because if you look back, if we do this post-mortem analysis, and which we did obviously now since there have been quite a good number now of companies which we lost over the time, it was 80-90% it was the team. So that's why we have much more and put much more emphasis on how to find out whether it can work and what is needed basically to make it work, and how to get a good feeling before we decide if it can work out or not. So that's something we are much more focusing on than in the beginning. So that's why if in the beginning we think every investment is going to work out and yield big time. And in the first fund, it was mainly it was Interhyp, so the mortgage marketplace in Germany, and Tip24, who are basically bringing lotteries online, kind of old-fashioned system made online, and that worked out quite well. So those two companies there were two other good ones, but those contributed mainly to the performance of the first fund. And did we know from the first day on? No, we did not, because the other companies have also had a good start. We had a company called Avax back then, which was almost about the verge to go public. They had very good numbers, the best numbers of all companies in our portfolio. They then didn't make it, and they were just disrupted by other companies in the course of that. I mean, it was good that we did not brought them public, because they would probably also tanked then pretty early. They were due for filing in April 2000, so this kind of thing. And then they withdrew, and then it's okay. Well, let's go after summer, and after summer it was even worse, and then it was over. Yeah, the party was over then. But sometimes you have these cases that you have companies which have a very good start and look really fantastic. They are not the ones who make it then at the end.
And you mentioned that now you're putting even more emphasis on the people and the analysis also of the team. So I'm curious, like, how does this look like in practice? Like, what are your steps to really get to know the people behind the product and the startup?
Yeah. Well, first we try to basically establish a relationship to work together. And what we don't like too much is basically being forced and handing out an LOI within a week. And so we don't like this situation that founders come to us. So are you interested? Next week we were expecting first LOI. So that's something we really don't like too much. On the other hand, we are in a much better situation today that because we have way more repeat entrepreneurs. We have way more possibilities also technically to look for and seek references. So that's much better possible than back then. So it was many people just came from university. They have had no experience. So it was kind of very, very different in that respect. So in this respect, we are in a much better situation now. And that's why we also have developed our own software, which helps us getting to know disruptive concepts, disruptive good entrepreneurs out there very early, even if it's too early for us to invest. We can invest early, and we do invest early, but even we like to get to know them as early as possible, to then establish a relationship, help them, without investing, and with this building a relationship, and then see how things evolve, but then also be around at the right point in time when it's about the first investment. So that's the way we try to build, which is not just good for us, it's also good for the entrepreneurs, because then the entrepreneurs also should find the right partner. And so it goes both ways in the end. So for the entrepreneurs, it also makes sense to build a good relationship and try to find partners, and have so many examples out now recently also with companies who have issues in the cap table, because you have different interests and who have raised maybe in 21 very high valuations, but nobody cared back then in terms of doesn't matter who it is. That obviously can haunt you then. So that's why it's also important for the entrepreneur to look for the right partners. We also basically always involve our head of people, and she's involved very early on, and she's basically then also giving an assessment of the founders team. So that's the way we try to get it to a holistic view, have everybody also involved in the discussions. We also try to basically involve many people on our end to get to know the team, to work together with the team, even interns. So, and afterwards, we also like to hear opinion from everyone. So not just the investment committee, but also everyone being involved. It's a marriage, it's 7 years more than 7 years typically. I think the average duration of a marriage is 7 years, so it's longer in all cases.
And you mentioned the importance of the team. I'm curious, like you have grown Earlybird now also over the years into a larger team. So how do you design a company culture and how do you then implement it?
But it has to be defined and has to be lived also. That's why we also have a team basically of HR who supports our portfolio company. This is in all details, it's how the company is welcoming you, how the CI is looking, how basically you clean your office. So kind of all these things, they all should basically pay and cater to your values. Those things and those little details you can much better observe, obviously, if you have meetings on site, if you see how they live, how they introduce their colleagues, how the office looks and so on. All these small little things give you some hints whether these cultural aspects are taken care of and how they are lived.
And for you personally, because you're also in the position of a leader, so how did it change for you what it means to be a good leader from when you started out and how you would see it now, also based on the experience you made that you just mentioned?
In the end, it's about sharing the same and living up to the same goals, and we have also had our on the partner side also our churn, I would say. So it took some time also within Earlybird to establish the sort of second generation after the founders. It took some time. Why did it not work out earlier? Because obviously there were no shared value. They were just different visions. Sometimes it's you share the same, then you realize, well, they're not really the same. It's also a different direction possible. And then in those situations, you rather should react and basically not try to make it happen.
I think entrepreneurship and especially also venture capital are in general very polarizing ways of living your life, because sometimes things can go exceptionally well, but which is like as part of the venture asset class, most of the investments are not successful. So what skills or qualities do you need as a person to excel in that very specific environment?
I think it's important to be very honest with your investments. Be honest also of the expected direction or outcome. We tend to be much more upfront now, as in the beginning, in terms of giving clear feedback with regard to the next funding. So if things are working not so well, we try to realize or basically communicate that we may be not happy and maybe also not up for the next round. People realize, okay, well, it's hard to find. We try to find a solution in terms of can we sell the company? Is there a buyer, is a natural buyer? Basically, can we do something with the company? So we try to be supportive in that direction. It doesn't work out always. No, it does not. But at least we try to be very, very front and open with in that regard, so that founders do not expect basically there will be funding forever and do one funding after the other. We could basically, given the fund has the reserves, but it's not an automatic thing that the reserves will be released to the next round, because in the end we have fund managers, we have a portfolio, and the best companies should get just the attention, but also the money to be supported. And the weaker companies, you have to find solutions. And whereas in the past, basically, we had also more write-offs in the past in the end, because we weren't early enough communicating that. So because if you do so, founders, and you come up with new ideas with you just create options in the course, and the option can be not necessarily can be bad.
And so you have been building Earlybird now over, I think, 28 years, right? So if we round it up to 3 decades, and you would give each decade 1 or 2 words to describe it, what would that be?
Well, the first one would be certainly basically completely undeveloped ecosystem. No clue on our end. Really learning by doing. That was probably the first phase. The second phase was a lot of making things better, basically also trying to establish a good and solid team setup within Earlybird. And the third, which is still ongoing, obviously, making also a good transition to the next generation. I would say that's something we've been focusing on. Again, we have failed in the past, but I think now we've done so because we realize also that many VCs are not taking care of this transition. So they want to basically do this forever and not give up on things, not share things, and so on. So that's something which is quite important because our idea was always that we should not, that it should basically live beyond us, kind of. Yeah. So it should continue and should become a brand, and hopefully even a better brand or better company than we have been building. So, and that notion is also part of the culture. Obviously, have to establish this, and also the next generation also have to live up to this. And that's something I would describe this third phase in which we are still in.
Yeah, because also the industry of venture itself is going through changes, which are also mainly caused by new technologies. And at Earlybird, you also implemented much more technology to find and also support your portfolio companies. What do you think are the next big challenges you are facing with Earlybird to stay on top of the game?
Yeah, it's exactly what you mentioned in terms of VC will change because it's obviously much more data driven now. So this kind of you make use of data is, I think, a thing which will also everybody basically adapt to a certain extent. We will build this out to not just finding the best talent out there, but also not the best entrepreneurs out there, but also find the best talent out there for our portfolio companies. So there's also a kind of data driven approach where we can support companies. And the next big challenge, I would say, well, it's hard to say. We have asked, but there's a question whether AI can completely take over and make investment decisions. I'm not sure if we're going that way, but at least we try to stay on top of this and make use of the tech out there to just do better decisions and be faster in decision making and so on. So that's at least something we try to keep up with. Will it completely change? Will it be completely basically built on kind of almost marketplaces, where you bring both sides together, like entrepreneurs and VCs? I'm not sure. Other than that, I think it's more, I wouldn't say specialized fund, but at least within funds, you need to have the specialist. I think this is something we need to develop. So it's much more important now to really be on eye level with the entrepreneurs and to understand what they're doing, what they're building, and to understand the tech, understand the sector, the competitors, and so on. So I think that's much more important than back then. So I think this development in terms of we rather leave out a sector which we don't have the competency, where we don't have a kind of T-shaped profile, really deep understanding of tech and the markets and so on. We'd rather leave out a sector if we feel we don't have the right team here.
And coming to an end, which episode of Earlybird are you most proud of when you look back at the journey?
Yeah, you made all the retreats. Well, the first, it was obviously the idea at all, because also we didn't know back then whether it was going to work out or not, or whether it's just one fund and then in the end is close, which has been the case, by the way. So with this kind of long period between 2000 and 2005, it was pretty tough in the end. We supported our investments, the good ones we had back then, with investing our own money in the end, our management fees. So we didn't get any salary for years to put this all into the best developing companies. So there was a pure entrepreneurship in the end. I would say now it's obviously that we have established the next generation and have also established a principle within this that it can continue. So it's not just the next, but it's also the generation after the next generation is also kind of the same setup.
But that's very cool. So we will experience that Earlybird will live long.
And it's set up for this, yeah.
Yeah, exactly. Seems to be. We have a closing tradition on the podcast, which is called the open letter. And you can address a one-sentence letter to a specific person, also to a group of people. So it could be, for instance, your younger self or future entrepreneurs or your team, for instance. So who would it be and what would you say?
What I would say, I would write a letter to the German politicians. And I would tell them, guys, it would take so little to make Germany even a better place for entrepreneurs. It really takes little. You just put this on top of the end and just realize that the next Mittelstand is not coming from the old Mittelstand. It has to be established a new Mittelstand. And a new Mittelstand can only come from basically the venture ecosystem. And why not doing the same like Macron does in France? It takes very little. We're not even asking for money. Sometimes we're also asking for money, put more money to KfW or EIF. We're not asking for this. We just put it on top of the agenda and welcome all the entrepreneurs basically to build companies here and support them the support is more needed than for Mercedes and Volkswagen, I would say, because this will not be the next Mittelstand, and this is very important to make just Germany a better place, because we have the tech, we have the R&D, we have it, but we shouldn't basically fall into this kind of MP3 is invented in Germany, but basically monetized elsewhere. So this kind of notion, I think we should keep in mind and basically readdress this now, because now we can't live from the old Mittelstand anymore.
Yeah, I agree.
Yeah.
Let's draft this letter.
Can make it way longer.
Yeah. No, so thank you so much, Christian. What I'm really impressed by is your ability to kind of like reinvent also yourself and Earlybird, and to keep innovating for such a long time. And I think it really shows your commitment to innovation. So, and I think also that's the only way you can stay on top of venture capital for 3 decades nearly. So yeah, thank you so much for this conversation and your openness to share it.
Thank you. Thanks, Louis. Thanks for being part of it.